Welcome to the Explainer. We spend so much time obsessively analyzing charts and trying to predict trends, but it turns out we often completely ignore the actual bridge between our analysis and the live market, and that's trade execution. The source material we're looking at today reveals the hidden costs of execution, and honestly, it is eye-opening. Choosing the wrong order type can quietly wreck a carefully planned account before the trade even gets a chance to play out. So we're going to explore the exact mechanics, contract sizing, and disciplined scaling rules presented in the research to see how we can stop leaking capital and finally tighten up our mechanical risk management.
Okay, picture this first scenario from the text. A massive, totally unexpected news event just hits the wires. It completely invalidates your entire trade thesis in a matter of seconds. And you are currently sitting in a highly leveraged, losing position. You need to get out immediately to preserve whatever capital you have left. In this exact moment, seconds literally feel like hours, right? Your only priority is absolute survival. The financial bleeding just has to stop right now.
Well, the core problem the research highlights here is slippage. When you hit that panic button in a thin, fast-moving market, that ideal expected price resting on your screen, it's basically a mirage. It might not be anywhere near the actual execution price you end up getting. If you need to dump 500 shares to save your account, but there are only 100 available at the current best offer, your order is going to relentlessly chew through the order book. It fills at progressively worse and worse prices until it's done. And in highly volatile environments, this discrepancy can absolutely annihilate your exit proceeds.
To solve this, the text points us directly to the market order. By using this tool, you're essentially instructing the exchange to prioritize speed absolutely above price. You step into the role of what's known as a liquidity taker. That just means you are aggressively removing existing orders from the book to instantly satisfy your own trade. The massive advantage here? Guaranteed execution. As long as the market is open and there's literally any liquidity available at all, you are safely out of the danger zone. So, what's the key takeaway for this specific strategy? The source material emphasizes only deploying market orders under very specific, disciplined scaling rules. You really should only use them when an immediate mandatory exit is required to save your account, when you're trading highly liquid assets where spreads are incredibly tight, or when the financial cost of missing a massive move is just way worse than absorbing a little bit of slippage. But let's flip it. What if you aren't in a blind panic? What if you were just tired of experiencing massive slippage every single time the market spikes? We have all felt the pain of watching a perfectly planned entry get completely ruined by a terrible fill. If you are sick of accidentally giving up your trading edge and your hard-earned profits straight to the exchange just to get into a position, the research suggests it is time to shift tactics entirely. To actually control your execution costs, the strategy presented suggests a total mindset shift. You have to consciously transition your role in the market from a liquidity taker who desperately prioritizes speed to a liquidity provider who strictly prioritizes price. It is all about drawing a line in the sand. You have to stop aggressively taking whatever scraps are offered and start dictating your own precise terms to the market. And this is exactly where the limit order comes into play. And the mechanics here are pretty fascinating. It gives you total control. Say you place a buy limit at exactly $150. You are setting a hard, unyielding boundary. You won't pay a single penny more than that. Your order just sits patiently on the exchange, acting like a trap, waiting for the market to come to you. The trade-off, though, there's absolutely zero guarantee of execution. If the market never drops down to meet your price, your order just sits there in the queue, totally unfilled. So your key takeaway for disciplined entry rules here is to deploy limit orders when you want to act like a sniper. The text advises using them when you've identified a highly specific technical support or resistance zone, when you're trading low-volume assets with wide spreads, and crucially, when you are completely okay with missing the trade entirely. Honestly, sometimes sitting on your hands and missing the move is infinitely better than chasing an emotional spike and instantly finding yourself in the red. Now, speaking of identifying those precise technical support and resistance zones, you need the right tools to even spot them in the first place. You can actually save $15 using our referral link in the description to get the standard in charting over at TradingView. The source analysis relies heavily on clear, fast data, and TradingView truly is the most reliable way to follow the markets and chart out your complex trades without any distractions. All right, let's jump to our next micro story. Imagine you are in a phenomenal trade. You successfully used a limit order, got the perfect entry price, you're feeling incredibly confident, but suddenly the market goes violently against you. The floor just completely falls out.
How do you mechanically prevent a catastrophic loss that could threaten to wipe out your entire funded account in just a few agonizing minutes? Well, the source material reveals a massive, account-destroying trap right here. A lot of traders try to get way too clever by using a stop limit order to defend their capital. They set a trigger to act, but also a strict minimum limit price they refuse to sell below, hoping to avoid selling at a huge discount during a flash crash. But here is the fatal flaw the data points out. If the market completely gaps over your limit price during a violent plunge and never returns, that defensive order never actually fills. You're left hopelessly trapped, just watching your losses mount exponentially. The true defensive solution recommended to prevent this exact nightmare is just the standard stop order. What's so brilliant about this is that it stays completely hidden from the market until your specific pain threshold price is breached. The vital mechanic to understand here is that once that trigger hits, it automatically morphs into a standard market order. It completely abandons all price sensitivity because its one and only goal is to get you out of that burning building immediately.
So the core takeaway for your risk management rules is non-negotiable. Always use standard stop orders to mandate a hard exit point. Yes, you might suffer some brutal slippage because it triggers as a market order, but you have to mentally accept that slippage as the necessary cost of absolute survival in this game. Interestingly enough, you can also reverse this exact logic to automatically buy into confirmed breakouts, letting the market thoroughly prove its strength before you commit capital.
Okay, so you finally have your perfect entry limit, and your defensive stop order is totally dialed in. But the text warns about this hilarious yet totally devastating operational nightmare. You hit your profit target, you celebrate a massive win, you walk away to go grab a coffee, and then realize extreme volatility just triggered your lingering forgotten stop loss anyway. You literally just accidentally opened a brand new, highly risky short position while you were standing in the kitchen enjoying your victory. This terrifying little scenario is known as double fill risk, and the solution to this isn't simply paying closer attention, it needs to be entirely automated. You have to link your profit target and your defensive stop loss together logically within the exchange's platform itself. The mechanics dictate that when your profit target is successfully hit, the trading platform must automatically and instantly cancel that defense order so it doesn't accidentally trigger later in the day. And this brings us to the one cancels the other, or OCO bracket order. It is a functional pairing of two distinct instructions. If your profit limit fills, the stop loss is immediately deleted. Conversely, if your stop loss triggers first to save you, the profit target is removed. This brilliant setup completely eliminates manual operational errors and lets you confidently manage an active trade without having to stare unblinkingly at your screen for hours on end. Finally, let's look at the absolute harshest trading environments imaginable. Consider what actually happens mechanically to the market and to your orders in the literal milliseconds following a major central bank interest rate decision or a massive surprise earnings announcement. The underlying market structure just completely changes in the blink of an eye.
The research shows that during these extreme high-volatility events, the order book essentially empties out. Liquidity just vanishes into thin air, and the gap between the highest willing buyer and the lowest willing seller widens dramatically. As a direct result, retail traders who blindly throw market orders into this void suffer massive catastrophic slippage. They routinely get filled several percentage points away from the very last traded price, instantly destroying any statistical edge they had in the first place.
The source material notes that professional participants survive this absolute chaos by using limit orders exclusively during these times, fully accepting they might just miss the move altogether rather than risk a mathematically awful fill. Now, to master more of these professional execution techniques, contract sizing rules, and structural strategies, make sure to grab your copy of the Funded Micro, Modern Future Strategies for the Prop Firm Era at franksreport.com. I'll leave you with this final provocative thought from the text as you look at your charts today. When you place your very next trade, are you consciously choosing the precise price you pay, or are you just blindly accepting whatever the market decides to take from you?